So this is a rough outline of what I'd like to talk about, sort of where the economy is now, what it's looking like as we get out of this virus-induced recession, something about lasting changes that we might see as a result of what we've been through. And then I'm going to spend a lot of time on the last question, which is we've got this huge government deficit that we're running, a lot of easy money by the Fed. And so what is the effect of that going to be? And I guess I'm 2 years away probably from retiring. I have fixed income pensions. So if that is inflationary, it's of real concern to me. So I thought maybe it might be also a concern to people in the audience today. As I talk about this, what I want you to be aware of is sort of how confident I am about anything I say. So for example, knowing where the economy is today, I think we've got lots of data. We sort of know where we are, but the story is complicated. So you have to be careful how you interpret the numbers. A couple of months ago, I would have said it's very uncertain sort of what the economy is going to do as we get out of this virus. But I think that's becoming a lot less uncertain as the vaccine rolls out and we get more economic data that's coming in each month. On this question, people are asking economists these questions, but my advice to you is don't listen to any of the economists, that you probably have as good an insight about, the lasting structural changes as any economist does. And I'll explain why I think that in a second. And then finally, the important thing to know about this last question is that there is a huge divergence of opinion among economists about what the effect of these big budget deficits and the Federal Reserve's actions will be. So economists don't agree at all, and the division is pretty sharp. So jumping right in, this is a picture of the economy, our GDP over the last few years. I've stretched it back a few years because I wanted to make sure everyone knew coming into this recession, the GDP was not growing particularly fast, 2.3%, you can see there, compared to, let's say, 3% as the long run average. So great source of frustration first to President Obama and then to President Trump that we weren't growing that fast. And that'll play a role in the story I'm going to tell later. So we had a big dip, everybody knows that, but we're almost back to where we were as of the fourth quarter of last year, which is the last quarter in which we have data, so 2.4% below the peak. Just look around the world, Europe is below us. They, as you know, they may even do worse than this because they're having a sort of a second round of shutdowns, but they're still 5% below their peak. Japan has almost entirely recovered. I'll talk about China in just a second. So this is another way of looking at what we've been through and where we're going. So this is the blue line is the unemployment rate. And what I've done is to put at the top frame of reference. That's the highest unemployment rate we had seen in the last 60 years before this. The green line at the bottom is the lowest unemployment rate we've seen in the last 60 years. And the average over that 60-year period is that line in the middle. So what you can see here is we came into this recession very nearly as low as we'd seen in recent history as far as unemployment is concerned. We quickly went to a number that was higher than we'd ever seen since the Great Depression. And but the unemployment rate has fallen relatively rapidly, and we're now more or less at what the long run average unemployment rate that we lived with for 60 years. I think one other comment here is that often we see the unemployment rate fall because people drop out of the labor force. They become discouraged and they stop looking for work, so they're no longer counted. In this case, the labor force participation rate has actually been going up since last spring. So that's good news. It means we're finding jobs for people who were previously unemployed, but also people who are re-entering the labor force. So that's relatively optimistic. This is a picture of what's happened to international trade, and I've divided into goods and services for reasons that'll be apparent. Our trade in merchandise, imports and exports dropped 25%, but it has almost entirely recovered as of fourth quarter of last year. Services, bigger drop, and only a very modest recovery, and that's because trade and services includes international tourism. So obviously that has not recovered. We're still way before where we were, way below where we were. This is a picture of sort of what's going on in trade. Okay, our imports have recovered a lot, but not so much our exports. So our trade deficit has really gotten quite large, and I expect this to continue because with these big federal government deficits, we're essentially dissaving a lot as a country, and I would expect that to show up in the trade deficit for at least the foreseeable future, the next couple of years. This is China, if you're curious about it. China has basically fully recovered. This is the rate of growth of GDP on an annual basis. So they had the big plunge, but they had a big recovery in the fourth quarter, and they're back to where they were before the virus, they encountered the virus. Again, you can see on the left-hand side of the graph, the sort of downward sloping line. China's GDP growth has been, gently declining for a decade now. And even though I expect growth to be pretty big this coming year, I think they're going to get back to that decline in their rate of growth, which is occurring for reasons that are entirely, explainable. Okay, so when I think about recessions, I always like to think about, well, compared to what? What does this one look like compared to the recessions that we've been through in the past? So there have been three big recessions in the last 50 years. And one way of measuring their severity is GDP goes down in a recession. How long does it take us to get back to where we were? And so this tells you that in 74, it took us 2 years to get back to our previous peak in GDP, and the other 3 years. So the implication of that is we're in a pretty good position. We are going to be back to the previous peak GDP this time within a year. So that's pretty encouraging. Another question you can ask yourself is, well, how long does it take us to get back to a reasonable unemployment rate? So what I've put here is the number of years after in a recession, you go above the long run average unemployment rate. How many years does it take you to get back below that 6%? And you can see here that sometimes that's a long time. In 1980, 7.5 years, we lived with unemployment above 6%. Here, we're going to be back below that number this quarter. So that means it's taken us a year. So the implication is when you hear people say a V-shaped recession, which is one of the ways people describe it, I think that's entirely appropriate. It's a V-shaped recession. The snapback looks like it has happened. And as long as you remember one thing, and that is that this recovery of the economy has been very, very uneven. Okay, so this is a picture of how we spent our money in the fourth quarter of last year compared to the fourth quarter of 2019. And the story, you can summarize it, is perfectly what you would expect. We stopped buying services, but we bought a lot more goods. So we bought, home furnishings. I understand we bought a lot of boats and things like that. But of course, we didn't buy transportation services or food services or any of the things that are service intensive. And we didn't buy gasoline because we weren't going anywhere. But so again, good recovery, but very uneven depending on what sector of the economy you're in. Sorry for all the lines on here, but this gives you sort of the same story. This is employment across the various sectors. And if you look at that yellow line in the middle that dips down, that's leisure and hospitality. So biggest losses, we all know that. That's restaurant workers and travel workers, and a recovery, but not really a very great recovery there. And unfortunately, that's where there are lots of low-income jobs. And you can compare it to financial activities, the green line, where there's not much of an employment loss at all. And of course, we've got more higher paid jobs in the financial sector. So again, very recovery, but very different effects depending on your sector and your wage level, your income level. I thought I would include this because it's an interesting commentary on being careful of how you interpret the numbers. So this is average hourly compensation of workers. So production workers, non-supervisory workers in the economy by industry. And if you looked at this, you'd say, it doesn't look too bad. We have some dips around the time of last spring, but then things got back on track. The problem with this is it disguises what's really going on. So if you look at retail, you have this strange bump up in average compensation, and then the compensation grows. So you might look at that and say, oh, they're doing pretty well there. The problem is that the reason you have that bump up is because in each of these sectors, the people most likely to lose their jobs were the low wage people. So in the retail industry, I might have retained the store manager, but I might have, let's say, laid off the stockroom worker or the cashier. And so when I go back and measure average compensation, I've got higher income people that I'm measuring that with post the virus. And so it makes it look like wages have been behaving, quite reasonably, but in fact, it disguises the fact that I've laid off low income workers. So again, just a lesson in interpreting the numbers. Okay, so that's sort of where we are. How about where we're going? I wanted to include this. This is industrial production, an index that the Fed puts out. And, the story here is this nice, smooth growth. We continue to, the industrial production continues to rise. Other good news, we added 379,000 jobs to the economy in February. That's a superb number. It's about probably 4 times the number required just to keep pace with the additions to the labor force. So again, that's very good news as well. Again, remembering we're still down about 9 million jobs compared to where we were when the COVID crisis started. But again, a good outlook. The numbers are coming in and looking very positive for continued snapback in the economy. This is another forward-looking index. The Institute for Supply Management collects information from purchasing managers companies. So they're saying, what are you going to do in the future as far as purchasing? And if that, you can see that is not only rising, but higher than before the COVID crisis. So that's an indication that this growth is going to continue, the growth we've seen since, let's say, the last quarter of last year. And then this is a chart I put in here because it needs some interpretation. By the way, a chart like this appeared on the second page of the Wall Street Journal today. So if you've already read that story, I apologize. But this is the household savings rate. And you can see it bouncing around pre-crisis, 5, 6, 7%. And then it jumps up in the spring of last year. Of course, it jumped up because we couldn't go to the movies and we couldn't go to restaurants and we couldn't travel. So we saved a lot. And even though the savings rate has dropped a little bit, it's still substantially higher than it was before. So what's the implication of this? The implication is that we have, in the aggregate, we know that consumers tend to smooth out their saving and consumption over their lifetimes. We've got a couple of economic theories that explain this: Milton Friedman's permanent income hypothesis and Modigliani's life cycle hypothesis. And so if we tend to smooth out our consumption and saving, and we've been forced to oversave in the last year and the first part of this year, then the likelihood is we're going to overspend for some period as we come out of this COVID crisis. So again, we should expect to see a real resurgence of consumer spending. That's good for the economy and that's good for jobs. So again, a positive outlook for the future. Although we want to keep in mind, everybody knows we had supply chain problems back last spring. Some of those were due to just production problems, but later in the year, we had supply chain problems because firms did not anticipate how quickly the economy was going to recover. And so they were caught short. And with this burst of consumer spending that we expect, as soon as life gets back to normal, it's possible that, again, we'll see a round of supply chain problems. My wife and I wanted to buy bicycles, and it took us, we were on the waiting list for 6 months to buy 2 very simple non-gear shift bicycles. Okay, third topic. What about the new normal that everybody talks about? And I wrote down, this is just things that people talk about. Are we going to have a permanent shift to more remote working? There's already been a pattern of migration out of the big urban centers Is that going to be accelerated, more migration, let's say, to the suburbs because people don't have to commute if they can remote work? Online shopping, one further nail in the coffin of brick and mortar retail. Food delivery going to have some effect on the way restaurants survive. And with respect to travel, I don't think everybody is expecting leisure travel to come back, but are we going to have a permanent change in a reduction in business travel? That's the big question. And again, here, I don't have any special insight that you guys have. The economists generally do a very poor job of predicting big changes in society. And I remember my MIT classmate Paul Krugman confidently said that in writing in the 1980s that we were about to enter an age of diminished expectations with very low economic growth ahead, just before the 90s occurred, and we had one of the longest economic expansions in U.S. history. Greg Mankiw at Harvard confidently predicted that we were going to have a housing bust beginning in the late 90s, just before we had a great big boom in the housing sector. And of course, no economist foresaw what was going to happen with the financial crisis. So I would not listen to economists opine on these topics. You could ask an economist, well, what are the implications of this if this does come about? So for example, if we have less business travel, then it's quite likely that the cost of leisure travel is going to go up, because in the airlines pricing model, essentially business travel has been subsidizing leisure travel. David Autor, who's at MIT, tells us that if we do have a continued migration out of the center cities, that's going to differentially hurt a lot of low-income people. We tend to forget that there are a lot of service jobs in those cities, restaurants and laundries and things like that, where there are low-wage jobs, and those workers will have a lot harder time migrating to the suburbs, along with the people who may or may not be migrating out of the cities. As far as remote working, it's not an economic insight, but you may have seen that the CEO of Goldman Sachs last week said that they definitely are not going to permanent remote working. Said we've got a collaborative, apprentice style environment here, and it doesn't work remotely. We want everybody back together. I'll just make a comment. I'm in my fourth semester of at least partially, most of it's been hybrid, but a lot of Zoom teaching. And I just gave my midterm 2 weeks ago, and I can confirm people are learning so much less. And so it's very hard for me to imagine that, for instance, if we thought there's some sort of permanent change in business schools, I don't see it happening, because not only are students learning less, they seem to, the learning gap seems to be accelerating the longer they're exposed to Zoom. And it really comes down the same reason that the CEO of Goldman Sachs wants his workers back. You really can't engage in a collaborative learning structure over Zoom in the same way you can when people are in the classroom. So that's all I'm going to say about permanent changes. Let me go on to my last topic, which is, do we expect to see higher inflation ahead as a result of all of these interventions in the economy? And as I promised, there are two conflicting views on this. And so I thought I'd sort of go through one to make that argument, and then go through the counter argument. So the first argument is, of course, we're going to see higher inflation. Larry Summers, the past Treasury Secretary and Harvard president, said this week that we're seeing the most irresponsible economic policy of the last 4 decades right now. And so the argument here is we've got these huge federal government deficits. They're coming on top of an economy that I already showed you was already in the process of recovering. So we don't need any more stimulus to have the economy recovered. And then on top of that, we saw that it's very likely we'll have this burst of consumer spending on top of all the federal spending. So sure, we're going to have a lot of inflation. This is just a picture of the budgetary impacts of the bill that was passed last week, the 1.9 trillion. So you can see here, this is the Congressional Budget Office and what they were already forecasting, or we already had a budget deficit of about 15% of GDP in 2020. This gives you, they were forecasting big deficits anyway, and the rescue plan is simply going to add to those deficits. So we're up to 16% as the projection in 21 and 6.4% in 22. And you might look at that 6.4% number and say, oh, well, thank goodness it's small. Well, it's smaller than the other two, but that is the largest deficit as a percentage of GDP that we have seen. We haven't seen another one like that. You have to go all the way back to 1947, coming out of the Second World War. So a succession of really large government deficits. Now, the one mitigating factor is something you've heard a lot of probably criticisms of the $1.9 trillion bill. And part of that is that there's a large slice of it that's not going to stimulate the economy at all. And stimulate, we mean add to spending, which then adds to economic growth and jobs. So to the extent a family lost its job, somebody in the family lost their job, and they get this $1,400 check, that obviously they will spend it, and that will stimulate the economy. But a lot of those $1,400 checks are going to go to people who didn't lose their jobs and who make a fair amount of income. And again, going back to our long run patterns of consumption and saving, it's quite likely that a lot of that money is going to be saved and not spent. So it's not going to be stimulative. None of the 50 billion plus that's going to prop up, pension funds in Democratic controlled states is going to stimulate anything. That doesn't work that way. And then a lot of the money is going to be spent slowly over time over the next 4 years. So again, my counter argument here would be that the 1.9 trillion is not nearly as inflationary as you might otherwise think. But on the other side of the coin, we have to look at what the Federal Reserve has been doing. So the left-hand chart here is what's been happening to the monetary base. So that's the amount of liquidity the Federal Reserve has injected into the banking system. And then on the right, the chart shows you what's been happening to the money supply. And in either case, there have been huge increases, both in the monetary base and the money supply, which you would think would be highly inflationary. In addition, the Fed is on record now as saying that it is willing to accept a higher rate of inflation. So the Fed, over the, let's say, last 10 years, has had this movement from not having a formal inflation target to then adopting a formal 2% target, and then more recently saying, okay, 2% is our sort of long run average, but we are willing to live and we want to live with inflation, which is higher than that for some period of time. That implies that the Fed can fine tune it. I'm not sure that's the case, but you put all that together and you say, clearly we're going to have more inflation, both on the federal government spending side and on the central bank money supply side. Well, is it showing up yet? So this chart, the red is the 12-month trailing inflation is measured by the CPI. And you can see that we're not seeing a whole lot of inflation right now. It's about 1% was if you go from February back 12 months, that's the inflation rate. The green is what we call core inflation. So we take out food and energy because core inflation has proved to be a better indication of the trend of inflation. And it's more or less telling the same story, not much inflation appearing. The problem with these numbers is that they are looking at data over the last 12 months, which included some periods of very, very low inflation. So more relevant is sort of, what do we think going forward? And I want to put a new line on here, but let me explain what it is before I do it. You can buy from the federal government a normal bond, okay, and the federal government will pay you interest, or you can buy an inflation adjusted bond, in which case you get lower rate of interest, but you then also get compensated for whatever the inflation rate is. That's called a TIPS bond. And you can think about the gap in yield between those two financial instruments as what the financial markets is thinking is going to happen to inflation in the future. Because if the financial markets, bond traders in New York think inflation is going to be high, they buy the inflation adjusted bond. If they don't think it's going to be that high, they buy the normal bond so that the difference in yield reflects their expectations. Well, if I put that line in, this is what we call the 5-year tip spread, the difference in the yields between those two instruments, then you can see that the financial markets are definitely expecting, have rising expectations for inflation, okay, going up consistently since last spring. Now, this is a monthly graph, okay, so it tells you what's been happening since last year. This is what's been happening since the beginning of the year. So when financial markets are adjusting to the announcements about the new Biden administration and the new amount of spending, and you can see here even more marked a rise in expectations of the financial markets for future inflation. Now, it's not runaway inflation, because you can see if you look at the vertical axis here, we're still saying financial markets are expecting inflation to be less than 3%. But again, those expectations are rising over time. So that's the first argument. Okay, we've got lots of money being created, lots of spending by the federal government, and the financial markets are telling us, they may be wrong, but they're making their bet that there's going to be more inflation. So let me do the other side of the coin, okay? And I would characterize this as, well, let's wait and see. And a way of thinking about this is to sort of put yourself in maybe I'll put words in the mouth of, let's say, Janet Yellen, our new Treasury Secretary and former Fed chair, and Jerome Powell, who's the current chair of the Fed. And I would think they would say, well, wait a minute, why do you think there's going to be so much inflation in the future? First, explain to me why inflation was so low prior to the COVID crisis. Because look, a lot of things were the same. Prior to the COVID crisis, we also had a large increase in the money supply and in the Fed balance sheet, okay, over the 10-year period after the financial crisis. We had 12 consecutive years of very large federal government deficits. Okay, they're not as large as the ones we're doing now, but they were still relentless in terms of time. We had interest rates that were lower than any time in the last 150 years everywhere in the world. So here's a picture of that. Okay, you can see down if you look at the far right, if you wanted to lend money to the German government for 10 years, you had to pay for the privilege of doing that. You had a negative rate in Germany and also in Japan. So the interest rates were low. And the big one is that we had, coming into the crisis, we had an unemployment rate of 3.5%. And so if you went back 10 years and you polled 100 economists, and I'm very confident of this, and you asked them, what is the lowest rate of unemployment that we can push the economy to without making inflation accelerate, what we call the natural rate of unemployment, then 99 out of 100 economists would have said, given you a number of 5% or greater. And a number of first-rate economists would have said it would be 6% or higher. 0 of the 100 would have told you that we could get the unemployment rate below 4% and still not have a burst of inflation. But we did. So again, the Janet Yellen, Jerome Powell view would be, all these things happen and we didn't see inflation. Why do you think it's going to occur now? Well, let's look a little bit deeper here. Why did we not see that inflation? Well, I can think of 3 reasons, okay? One is that labor force participation rate since the financial crisis up until 2019. So this is the number of people participating in the labor force. And what happens in every recession is that people get discouraged and they drop out of the labor force. And then when the recession's over, they come back into the labor force. But we never saw that upturn after the financial crisis. It just fell and then stayed low as we went into the current COVID crisis. And so one way of thinking about this is that if everybody who had dropped out of the labor force since the financial crisis re-entered, decided, no, I'm going to go look for a job, then the unemployment rate would have been 8% and not 3.5%. Now, everybody who dropped out is never going to come back because there's some demographic trends that are very long-term that are reflected in this. Baby boomers reaching retirement age and dropping out, but they only explain a small part of this. So one explanation for this low rate of inflation we've had in the past has been, well, we had all these people sort of waiting in the wings, so that the 3.5% unemployment rate really didn't measure the slack in the labor market in an appropriate way. And if firms had, rather than raise wages, we would just get those workers who came in from the wings to join the labor force. So that's one explanation. This is capacity utilization. So this is how much our factories and power plants are used. And it's sort of the same story. You can think about this as the unemployment rate of capital as opposed to labor. And what this is telling you is that, after the financial crisis, we very seldom even gotten back to the long run average capacity utilization. And we were certainly well below where we were in the 90s. So we had a lot of unused factory space, a lot of unused capital. And so again, that put downward pressure on prices and inflation. And then finally, this is sort of the rising importance of trade in the economy. How does that affect inflation? Well, it means that if prices start to rise in the US, we'll buy the goods from somewhere else. So the more global and open the economy is in the United States, potentially the lower the inflationary consequences are of faster growth. So those are three potential explanations. They're still around with us. I don't think economists have a good weighting of them, or even know if this is in fact an exhaustive explanation. But again, the notion here is that we didn't have inflation before. Why do you think it's going to occur again? Why don't we keep this policy of expanding demand and expanding the money supply in place until we see otherwise? Well, if you're like me and you say, okay, Jerome Powell, I'm willing to live with that. But I'm nervous because I'm going to be living on a fixed income pension and I worry about inflation. What questions should I be asking, to pay attention to as we go forward? Well, the first is this question about full employment. So again, full employment to an economist is what we call the natural rate, the lowest I can push unemployment. So there's just frictional unemployment. And if I try to go below it, I'm going to start building up inflation. And you might think it's going to go back to that 3.5% we saw before the crisis, but the counter argument is, well, when you have these sectoral shifts in the economy that may occur, you're increasing the amount of frictional unemployment. So if the Fed tries to push the unemployment rate too low to 3.5%, then that might be inflationary. Again, I'm thinking of John Kerry, announcing that all the Keystone Pipeline employees who lost their jobs are going to be making solar panels next month. It just doesn't happen that way. It takes time for people to find new jobs. So paying attention, economists not knowing what the right number is an important thing to keep an eye on. Second thing is the Fed has been criticized for decades of reacting too slowly, both to inflationary pressure or to recessions. So a big question is the Fed going to recognize if we have a burst of inflation, will it recognize that inflation in time? And here, I think I'm relatively optimistic, and I would say this is due to what I call the Bernake legacy. So I think everybody listening probably remembers Alan Greenspan as chairman of the Fed. So he would come out of a meeting in which the Federal Open Market Committee would have discussed, monetary policy. He'd get interviewed by reporters. He was almost never intelligible. He would say something very vague and people would try and read through the lines as to what he'd said. He also had a bad habit that when they were discussing the changes in policy, Alan Greenspan would always go first. He'd say, here's what I think. What do the rest of you think? Well, if you're the chairman, that's not a very good way to get a impartial discussion of people's views. So Bernanke really changed the way the Fed operates in a lot of ways. To begin with, he always gave his opinion last when he was asking the Federal Open Market Committee what they should do. He also instituted the publication of the minutes of the meeting. Again, very subtle, but you notice that the regional Fed presidents of the regional banks were much more public sometimes when they disagreed with what the Fed was doing. So a lot more discussion there. And all that contributed, I think, to an atmosphere of transparency where there's a lot more arguing over what the right thing to do is. which is exactly what you want to have happen when you're dealing in a period of high uncertainty. You want people of different views arguing with each other so that there's not a uniform opinion in the Fed. So that's good. Another question you might want to ask is, well, the Fed has injected all this liquidity into the economy. Does it have the tools to reverse course? And I won't comment on the technical stuff here, but yes, the Fed has given itself, or Congress has given the Fed some tools over the last 10 years that enable it to really have a much better control over the amount of liquidity in the economy. And then finally, there's a question of political will, because if we see inflation on the horizon, that means interest rates are going up. The Fed will have to let interest rates rise to prevent that inflation from occurring. That's obviously very unpopular with politicians. But again, we saw Trump beat as hard as he could on Powell when Powell was raising interest rates prior to the crisis. Powell resisted all of that. The Fed was still an apolitical institution. And so again, I'm relatively confident on that. So I'm worried about inflation, but I accept Powell's argument. And I hope that the answers to these questions are all ones that are answerable and go in the right direction. Okay, I want to spend a little bit of time at the end here talking about why we're in such a position of uncertainty right now. And a lot of it has to do with the fact that some of the basic ways in which we understand how the economy operates, in particular how the Federal Reserve operates in the economy, have really just fallen apart. And so to start with this sort of picture here, we have this very simplistic view. Often see it in the headlines of the Wall Street Journal or some other media source. And the idea is that if the Fed wants the economy to grow faster, it steps on the gas pedal and the car goes faster. End of story. If it wants the economy to grow slower, takes its foot off the pedal, puts it on a brake, and the economy grows slower. Just as simple as that. And in words, you might say it goes something like this: the Fed increases the money supply and interest rates fall. If we're in a recession, economic growth accelerates, unemployment falls, the economy moves faster. If we are already at full employment and the Fed steps on the gas pedal too hard, then we're going to have inflation. So this nice, simple story, the headline's always about the Fed changing the interest rate, okay? But if things haven't been happening the way you think they are, you might want to take a deeper look. So if you'll bear with me, what I'm thinking about here is you're sitting in your car and it doesn't go anywhere. You don't sit there and keep pushing your foot on the gas pedal. You don't get a flashlight and get on your hands and knees and say, I wonder what's wrong with my gas pedal. Nope. What you do is you open up your hood and you start asking, what are all the things between my gas pedal and the wheels that make this car run? You start looking at all the linkages between that gas pedal and what makes the car actually move. So again, if you bear with me, what I would like to do is take a look at the linkages between what the Federal Reserve does, okay, and what we call the real economy, the things we care about, the number of jobs, the things we produce. So this is apologies if any economists are listening, but this is my sort of simple breakdown of the linkages between what the Federal Reserve does and what happens in the real economy, which is the thing we really care about. So we begin with the first thing the Fed does when it wants to change something is it injects reserves into the banking system. So banks have to keep a certain amount of reserves against the deposits that you put in the bank. And the more reserves the Fed puts into the economy, then the more deposits can expand. And when deposits expand, also lending expands. So when the linkage here is the Fed injects reserves, bank lending then increases and the money supply increases. So that goes up. As a result of that, the federal funds rate falls. Now, again, what's the federal funds rate? It's that rate when you read in the newspaper, the Fed lowered the interest rate. It's this interest rate that they lower. okay, because that's the one they target. And this is a very specialized interest rate. It's the rate at which banks lend each other reserves overnight, okay, very short-term lending. That's all the Fed affects. When that happens, though, the Fed is assuming that if they change that interest rate, all the other interest rates in the economy are going to change as well. What that's going to do is make capital and financial capital more available, and it's going to drive down the cost. Firms are going to increase their investments, and people are going to build new homes because the mortgage rate is lower. And with some multiplier effect, that's going to increase aggregate demand and make GDP grow faster. So that is the, what's behind the linkages. If you see a textbook, especially one written 10 years ago, there was probably very little discussion of these linkages and more just a chart showing an interest rate and the Fed affecting the interest rate and then that affecting the economy. But this is what was all lay behind that. And we just want to point out that if the Fed does this and the aggregate demand exceeds the potential GDP for producing the goods, then we're going to have inflation. And bear with me, this next little slide, we tend to forget. This is what I call the real economy. We've got factors of production. So whether you're a Marxist or a right-wing economist, there's still labor and capital. Those are the things that produce the goods. So it may not be farm workers and tractors. It may be lab workers, and the capital may be intellectual capital of a drug company, but still there's labor and capital that produce output. In this case, I've said bushels of corn, but again, it could be video games. But the key thing here is if the demand for the output exceeds the ability of the labor and capital to produce it, then we've got two things that can happen. We have inflation, we drive up the prices of the output, or we have an increase in the trade deficit because we get the other bushel of corn from some other country. So again, remember, that's what's happening in the real economy is what we really care about at the end of the day. So let's go back to these linkages. So beginning in 2008, said the Fed injected reserves into the banking system, but the next part broke down. The banks didn't increase their lending. All right, and what happened there? So this is a picture of the excess reserves in the banking system. So these are the reserves that banks above and beyond those that they're required to keep. And if you look at the chart on the left side, you see it just bounces around about zero for a long time. You can draw that back as far as you want to in history. And what that tells you is banks don't normally like to keep excess reserves because excess reserves don't earn them any money. So they like to lend it out, and they like to give you a mortgage or give a company a loan and earn a higher interest rate on doing that. And you can see there's a little tiny bump in the middle there. That is 9/11. After the attack on the World Trade Towers, there was some concern that the financial system would freeze up. And so banks hoarded reserves as against that financial uncertainty. Well, everybody thought at the time they were holding lots of excess reserves. But you get to the fall of 2008, Lehman Brothers goes down the tube, other banks go down the tubes, and suddenly there is this huge amount of fear in the banking system. Banks saying, I'm not going to make anybody a loan. I'm going to hoard my reserves. And so the Fed keeps pumping in reserves, but they don't cause any increase in lending because the banks are just grabbing those reserves as a protection against the financial chaos that's going to occur. So let's go back to our linkages, okay? The bank lending didn't increase. The Fed funds rate fell because there were lots of reserves in the system, but the next part of the linkage stopped working. Mortgage rates and other rates didn't fall. So the Fed funds rate did, but guess what? You can't get a mortgage at the Fed funds rate. You've got to get your mortgage at the 30-year mortgage rate. And so this is what was happening to other interest rates in the economy. So you can see the blue line is the interest rate the Fed controls, the federal funds rate, but the 30-year mortgage rate coming down a little bit, but not very much. That top interest rate is like an investment grade bond for a firm. So when firms are financing themselves, they did not see the benefit of that Fed funds rate drop. And so you see, again, a disconnect in the linkage here between what the Fed is doing and what the rest of the financial world is doing. This is, by the way, when the Fed started to raise interest rates. This is the picture on the other side of the story. In 2015, the Fed started raising the federal funds rate, but you can see these other rates didn't respond. The 30-year mortgage rate was lower at the end of this period than it was at the beginning. And it's amusing to me because people just don't pay attention to this. The Atlanta Journal-Constitution had an article when this occurred, and it was someone carefully writing about how much more it was going to cost you for a 30-year mortgage as a result of the Fed raising the interest rate. But obviously the author of the story hadn't bothered to look and see 30-year mortgage rates haven't changed at all. Why should my mortgage cost have gone up? So back to our linkage, okay? So interest rates didn't fall. So what did the Fed do? It started intervening in the market directly by buying large amounts of long-term bonds. You may have heard the phrase quantitative easing. That was what it was called. So we're going right in. We're buying up portfolios of mortgages, and we're buying bonds directly in the market to drive down those other interest rates. Okay, and that's going to make financial capital available and make its costs low. Well, again, look at this chart again. I've extended it out. Those other interest rates did, in fact, start to come down, okay, modestly, but they did start to come down. But the problem is, and this is the other side. You heard about the Fed's balance sheet. Well, this is the other side of the coin. These are all the things the Fed bought to get the interest rates, the other interest rates down. But the problem is the last part of the linkage didn't work. The level of investment really didn't recover very much. Okay, and aggregate demand didn't grow very much. So GDP never even grew at its long run average. So all of this happened, and we had still a very sluggish response of the real economy. And here's a picture of what was going on. This is each dot is sort of the last 4 years worth of growth. And the story here is that when we've had a recession in the past, we always have a bounce back in the rate of growth of the economy. So we go below that, the red line is the average growth. We go below that, we bounce back. We go below it, we bounce back. Here, we had maybe a deeper recession in 2008, but as you can see, we really did not even get back to the average rate of growth. And underlying this, investment is the most volatile part of GDP. We never had investment get back to its long run average either. So again, it was this is what Keynes would have called pushing on a string. The last part of the linkage between what the Fed does and what the economy does simply wasn't there. So one way of summarizing this is a quote from Bernake when he was chairman of the Fed. This quantitative easing, so that's the Fed's intervention here, works in practice, but it doesn't work in theory. Well, if you've ever learned the scientific method, then you would probably say, Ben, what you're really saying is we don't know whether it works or not, okay? It's like saying the tribal chief a couple of thousand years ago said, hey, everybody gather around the fire tonight. We want to appease the rain gods. We're going to have a dance. We got to have a good harvest in the fall. The harvest arrives, okay? It's sort of mediocre, not that good. You expect the chief to say, well, maybe the rain dance didn't do us any good either. But instead, the chief says, I'm sure glad we had that rain dance, because if we hadn't had the rain dance, the harvest would have been even worse than it was. So again, we don't, Ben, by the way, I have an enormous amount of respect for Ben, who was with me at MIT as well. And so, but still, the thing is, we just don't know. The models didn't work, so we can't interpret that one way or another. All right, so a lot of uncertainty about the economy because things aren't working. This is a sort of reflection of that uncertainty. Beginning in 2013, economists we had recovered from the financial crisis, but economists started worrying about a future recession. So I just collected these headlines. The PIMCO big financial institution, 60% chance of global recession in 2013. Citibank, 2015, most likely scenario, global recession, 16, 17. America should get serious about the looming recession. So every year we're going to have a recession in the year ahead. Finally, in November 19, people were saying a recession in the year ahead. And guess what? The stock clock is right twice a day. We finally did have a recession, but of course it was, the cause of it was absolutely exogenous to anything that economists were thinking about before, just by chance that this recession happened. So let me just conclude. I don't know who Nancy Davis is, but she was asked about what's going to happen with inflation and the economy, and she said, nobody knows what's going to happen, especially the economists. So I will conclude from that and see if anybody wants to argue with me or push back or ask questions. Ray, are you? I see it, Alex, who's unmuted himself.
I guess this means an arm up. Ray, that was a great talk. Thank you very much. I really appreciated it. You know, I've thought for a long time that these longer term trends are due to demography. You know, that's like one of the underlying developments, like the long-term technological revolutions and things like that. So what do you think about this recent demographic stuff? Like, we know that people have been having less sex, and this has been going on, you know, for the last decade or two. I'm not sure among us retirees, but at least teenagers, the teenagers, yeah. 20 somethings, 30 somethings, they're having less sex. And the birth rate is also slightly going down. We're down to like 1.7 something now. And then we hit COVID. And in the pandemic, that really accelerated. And so some people thought we're gonna have a baby boomlet because everybody's sitting at home with nothing else to do. But the rate of sex went down and the birth rate went way down further. So it kind of accelerated this long-standing trend. So we have that, plus we have this big debate in our society about immigration. And some people are arguing, you know, we need massive immigration to really keep our society developing and the economy rolling and so forth. So I'm curious about your reaction to that, and what's the role of the demography, and what does that mean for inflation and how the economy is going to go for the next, whatever, 5-10 years that we're worried about our retirement money?
Well, I could give a whole course on that, okay? But please remember my statement that economists don't know much about long run things anyway. So I think this is my own opinion, we're going to see a blip because of this crisis, and then we're going to return to those long run demographic trends because they really rule. And for example, one of the things I tell my students in the economics course I teach is exactly what you talked about, immigration. What we would like to do, we're going to have, when Social Security was implemented, we had 3.5 workers for every retiree. We're going to, very soon, we're going to have 2 workers for every retiree, which means that we're going to have fewer younger people supporting older people, and that's just going to create a lot of tension in society. I think that's inevitably means young people are going to get taxed, and they're not going to like it, and that's going to really cause problems. So, and I don't see, you know, the problem is that the forecast, for instance, for Social Security, already embed relatively optimistic cases about immigration in them. Okay, and they take into account illegal immigrants. You know, the people who do that are not stupid. They know that. And illegal immigrants, much, you know, people don't realize this, pay about $8 billion into the Social Security Trust Fund every year, for which they are never going to collect benefits because they don't have Social Security numbers. They have fake ones, and you can't collect it with a fake one. So, you know, I think we're going to return to this. I think it's these demographic trends, and they are going to cause problems between the generations. The only thing that I guess I would see that is mitigating here is that I have great confidence in the ultimate growth of the economy and innovation. And so our children are actually going to be wealthier than we are. I really believe that. And they may complain about it a lot, and they may not work as hard if they're millennials and all that, but I think they're going to be wealthier. So I don't think it's going to be a disastrous burden, but it's something, you know, I certainly think going to happen, and it's not going to be helped by the enormous increase we see in the debt, because that's going to push out other forms of spending, you know, not in the next year, but in the next 20 years, when we have really the last baby boomers are all retired, and they're really eating up a lot of economic goods that they're not working to produce. I don't know, is that I can't say anything more than that. I'm sorry.
I appreciate it. Thanks.
Mm-hmm.
Okay, Lee has her hand up.
Right.
Hey.
Nice to see you.
Just so
So-
everybody knows, Lee and I traveled around the world with MBA students quite a bit in her earlier job.
So I wanted to ask you if you could comment on higher education, what's happening. I heard on a recent podcast that applications for federal loans are down. And we know the whole thing with Zoom and everything. So and then I know somebody who he was told that he had a job in the fall with 5 courses. And just this week he was told, no, your position is eliminated and you can apply for the new position, but it's 5 courses and advising.
Yeah,
So more hours, same money.
Well, we also know that the number of admissions to colleges has really gone up. That part of that's because you don't have to do a SAT anymore, or at least you don't. So that's, like, I don't know, Harvard's applications are up 45%. So again, this is wild speculation, but there's an article again in the Wall Street Journal today speculating on these big changes. And it seems to me that what we're going to have is a bifurcation in the world where we're going to have institutions that do a really good job of delivering in-person instruction, what I call collaborative instruction, the classroom where the student could say, I don't understand what you're saying, Professor Hill, can we go over that again? And then you're going to have another bunch of institutions that are go more to the Zoom model and are going to be probably a lot less expensive. But let's say institutions that were probably not delivering the collaborative model before very well anyway. And so I think that's probably says that you're going to see whoever got the disappointed in the job offer, you probably will see some shocks to some parts of the educational establishment. I think the ones at the top are probably not going to be affected. And that's again, highly personal. It's driven by me seeing my students. I give like the same sort of structure of an exam every year, so I can measure how little they're learning compared to they were before. And I know that in my class, I've got a group of 10 hardcore that come to the live class. So I'm doing hybrid, and they are there and they are asking questions, and we're having a great time. And I can observe that the people who are on Zoom, the story is we can make Zoom happen just as well as live instruction, but we can't because they are not interacting enough, and they're going, I don't know, going to make a cup of coffee in the middle of the discussion or something like that. So I think, the top institutions are going to deliver that old-fashioned in the classroom discussion. But I think you're going to see a lot of proliferation of models where, again, you're going to have a more effective way of doing it via Zoom, and that's going to have implications. You're going to probably, the Wall Street Journal today speculated you'll have bigger classes because they'll all be on Zoom, more TAs, more star lecturers, but less overall, demand for faculty.
Thank you.
Just an idea.
Denise has her hand up.
Hi.
Hi. You're not appearing. Are you supposed to appear on my screen?
Oh, sorry. Okay, now can you
Okay. Yes, there you are. Okay, good.
So this is an area where I'm usually fogged. I don't know a lot of economics, so part of the connections often slip.
And I apologize for going into so much detail.
Well, no. I mean, the only way I can figure it out is to hear somebody tell me something about it, right? It's not like I don't want to know something. It's just, it's hard to start from a kindergarten level. So I had a question originally, but something you just said, I think I'm going to ask you about that. So in your prediction about what's going to happen in the future, you said, well, you think your children are going to be richer and so on and so forth, right? And I would say to you, that may apply to a lot of people, but there's a whole section in the bottom of the economy where that will not be true. traditionally, African Americans, their children are not going to be richer. They haven't ever become richer.
Oh, no, that's not true. They are still disadvantaged, but that is that they are much richer than their parents were at the same age. So we've got to make the
Okay,
right
I see.
comparison.
Right.
Okay.
So, but if you look at accumulated wealth, I'm not sure I would agree with that, only because there's a wonderful piece in the New York Times that shows how middle-class Black boys are less likely to remain in the middle class, right? A significant portion are less
Mhm.
likely. So there's a downward trend where people, sorry,
That's all right.
where there's a downward trend. So there's a portion that stays high and lots fall out. I think the same is true for the Hispanic community, although I don't have data to support that. And I say this because it seems like there's going to be a higher proportion of the population that either is not really participating and then becomes a drag on the economy more than it's contributing to it.
Mhm.
Which we sort of are looking at how that's ended up in our politics today. In that sense, then it seems like going forward, things will be increasingly unstable.
Well, the implication of that is we should elect Biden out of office as soon as we can, so they'll stop increasing the national debt, so the next generation won't have to pay it off. But my point is, I'm just generally more optimistic that I'm not making an assertion that everybody in society is going to be better off. But I think we underrate. For instance, economists, we can do the comparisons in terms of financial numbers, but when economists go out and calculate things like what is the percentage of families that have air conditioning or washing machines or cell phones, we see a huge improvement in standard of living. And again, were you there when I was talking about my flat tire outside of Augusta? Okay, so the fact that we're not even counting things like the fact that my parents had a phone and I had a phone, but my phone is tremendously more powerful than my parents' phone.
Yeah.
And so, but I'm just more optimistic. We're going to arrive 20 years from today. Yes, I think we may encounter some real problems of the national debt, squeezing out other forms of spending, but I'm very confident that our economy can produce in the aggregate, not for every single person, but in the aggregate, the wealth to pay for that. So I'm optimistic in the long term in the aggregate. So that doesn't mean we don't worry about parts of the economy, and that's why I emphasize the unevenness of this recovery. You really have to make sure you're not when you're looking at the big picture, you're not forgetting about the little picture as well. That's all I can offer you. It's like I don't know what's going to happen. I don't have any data on 20 years from now, so I can't impress you with that.
Yeah. Okay, so my other question was why? Because it seems like much of the economy operates on a perception of on perception that you showed the chart about financial markets and how they things are based on what's perceived in the financial market that then drives where the future is going to go.
No, that's a misinterpretation.
Okay.
What we're saying is that in this case, I think you may be right in some instances, but in this case, what we're saying is the financial market, the expectations about inflation have then driven those differences in the financial market. So we're inferring from what that blue line, the tip spread, that's the financial market's reaction to what they are expecting to have happen. It's not the other way around. It's not a matter of perception, but it is in the sense that they're forecasting something. But these are, sober-minded bond traders. They're not people trading GameStop who have no idea what they're doing. And so that number is just saying they're expecting inflation to rise.
So what happens when they're wrong?
Well, what happens when they're wrong? That would mean that Jeremy Powell and Janet Yellen are right. We don't have to worry about inflation as much. But I think I don't think there are any consequences of them being wrong. Financial markets can be wrong all the time. And that means, some people who invest in those financial markets lose and some win, but it's not a big consequence of doing that. It's only when they're wrong about things that, for instance, the value that the assertion that, I can buy a portfolio of mortgages in 2007 because we're not going to have everybody default on their mortgage.
Right.
That we do have when financial markets are over enthusiastic like that, then we have a financial crisis, and the financial crisis has some real consequences. But I don't think there's any danger in a financial crisis occurring if the financial markets are wrong about future inflation. I mean, we'll just have some bond traders that are slightly disappointed. Okay.
Thank you.
Mm-hmm.
I hope that didn't sound too dumb.
No, not at all.
Okay, Gretchen has her hand up.
Yeah, hi, I think
You're on.
I'm muted. Okay, great. You've had so much experience working in Asia. I just thought I would ask what you're thinking about, trade with China and other Asian countries in particular, otherwise trade, tariffs, what things are looking like in that area as we move forward here, especially under Biden instead of Trump.
Yeah. Okay, I don't know where to begin on that. One thing that we just noticed, a worldwide trend over the last 10 years, world trade in goods has been growing at the sort of rate of world GDP, as opposed to twice the rate in the previous decade. Trade in services has been growing faster. So one of the overall things is that means tourism, investment banking, those things have been growing in international trade faster than goods. Second thing is, again, we're going to see buy shares in, if Savannah Port was a public company, buy shares in them, because we're going to see, again, I think a whole lot of imports coming in, a whole lot of trade coming into the US. We already have backlogs at a lot of our ports. For China, I think the mistaken view of the Trump administration was that if we put tariffs on China, we're going to reduce the trade deficit. But the trade deficit is driven by macroeconomic factors, and it's not going to change. We shifted some procurement outside of China to other countries. So that's, I think, one of the things that happened is people who are building up their supply chains took them out of China and maybe moved them to Vietnam or someplace like that, which was going to happen in the long run anyway, because China's wage costs are rising faster than the rest of Asia. So we're going to see that shift. But we're going to have a trade deficit with China for as long as any of us are alive, I guess. It's just not going away. And again, the big driver is our macroeconomic factors. So we can put tariffs in place all we want to, but it's not going to change anything. So I hope that the tariffs are removed and we get back to a more free trading environment. I'll make one other comment, which is people don't understand as well. We have this idea that we lost all these manufacturing jobs because we had outsourcing and we have this big trade deficit. But if you look at the numbers, what you realize is the reason we had the loss of manufacturing jobs over the last decade is due to two things. The percentage of GDP that the things we wanted to buy that were manufactured, dropped precipitously, because what we wanted to buy was services and not manufactured goods. So we as consumers really, as income grew, we stopped buying manufactured goods. We wanted to buy services. We wanted to go to the movies. We wanted maybe video games. We didn't want to buy things that were made. So that's the first part of it. And the second part is that our workers' productivity hasn't grown all that fast, but it's grown substantially. We needed fewer workers to produce those things. And in either case, so if you say, what's the change in consumption patterns plus the growth in productivity, that explains, 80, 90% of the job loss in manufacturing, not the fact that we imported those goods from somewhere else. It's a real mistaken view to think that somehow if we, stopped all trade with foreign countries, we would restore our manufacturing capability.
And just a quick follow-up with a question, even more ignorant than Denise thought her questions were. What's the problem with trade deficits? Why are they such a bad thing?
Well, again, just go back and say, but a little bit of technique. We have what we call the current account, which is sort of our trade deficit, and we have the financial account. Okay, and that's financial flows. And the two of those have to equal zero because we have a system of flexible exchange rates. And one reason that we have a trade deficit is because the financial account is so positive. People want to invest in the US, okay? The dollar exchange rate has to clear in the market. So if people are bringing in foreign currency to buy dollars to invest in treasury bonds and New York real estate, then there's got to be a flow in the other direction in our trade deficit. So to some extent, it's not a problem at all. I think the only issue is the corresponding the part of that trade deficit has to be financed by debt, okay, and by debt of the U.S. government. So to the extent that we're running big budget deficits, that's leading to a trade deficit, and we're building up indebtedness to foreigners. That's something, it's not a crisis, but it's something we have to keep our eyes on. But generally speaking, no, there's, the big issue for an economist would say, you don't want big variability in the trade deficit, because that's really disturbing to, people lose their jobs because of something that happens, from year to year, a lot of volatility in trade with foreigners, as opposed to, the long-term trends. So, again, part of the things to keep your eye on is that you put a tariff on, let's say, steel, and people who are in industries using steel lose their jobs. That's very disruptive to the economy.
Thank you.
Mm-hmm.
And Spencer has his hand up.
You're still up there. There you go.
I was going to ask you about what the future is for disparity and go in those earlier questions, but now I've evolved to this one. So we did this big stimulus package, which some people say is going to go into investments and not to buying groceries or paying the rent for some people. But I'm wondering, I don't know the details of it, is any of it going to things that are going to sustain productivity in the future, long term? And if whether it is or not, what does this hold for a next project, infrastructure project?
You mean the
infrastructure, which I'm just reminded that the size of our stimulus is much larger than the Belt and Road project in China.
Yeah.
And
well,
also about the same as our F-16. Value of our F-16 is about the same as the Belt and Road. Belt and Road seems to be have a lot of implications, political and but infrastructure in this country or even around the world seem to be things that you build that if I was going to get some money and I decide I'll invest it in the market, or I'll invest it in, or I'll just put it in the bank, or I decide to remodel my house. If I remodel my house, that's something that's going to generate, future things, going to produce jobs and everything. So what is the infrastructure thing going to happen? Is it going to be, and what effects is it going to have on the economy if it does?
Okay, so I teach an economics course, and I also teach a course in project finance, financing large infrastructure projects, which is what I spent most of my non-academic career doing. So I'm going to give you a really contrarian view on this. Okay, well, first of all, we had remember the shovel-ready projects that we had in the stimulus back in 2008, 2009. This idea that we're going to stimulate the economy through infrastructure is a really bad idea, because those things, big projects take a long time to unfold, and they should be disassociated with, like putting your foot on the gas to make the economy grow faster at any given moment. I am amused sometimes because you're actually the first person in a long time who has used the word infrastructure without putting crumbling in front of it. And so we all, politicians always say, we got to fix our crumbling infrastructure. And if you remember that Trump, during the debates, if you watched them, talked about how wonderful the Chinese airports were. Our airports are terrible. Their airports are great. Well, what people don't realize is that China, before the crisis, was getting up to spending. It was trying to keep its economy growing. It was spending almost half of its national income on capital formation, okay, which is a huge amount. And you have to ask yourself the question, if you spend that much on capital formation, can you possibly find things to spend it on that have a high rate of return? So the pushback to Trump and the airports was, yeah, China built a lot of airports that aren't very used. It built a lot of roads that aren't very used. It built high-speed trains that don't carry many people. And we all know it built lots of apartment buildings that nobody's living in. So that is, to answer, you're very unproductive for future growth. It's one of the reasons we're seeing the Chinese growth rate slow down. My problem with infrastructure is that politicians are the worst people to be directing how we're going to spend our infrastructure, because what's going to happen is we're going to build the bridge in my hometown, so we have the future tax dollars and the jobs. And first of all, I think there's our infrastructure generally. I'd like to see somebody actually measure the amount of crumbliness in the infrastructure and tell me about it before I assume that everything is crumbling and we need to spend another couple of $1 trillion on it. And I'm in particular worried if we get something, people are proposing National Infrastructure Bank, which to my mind is just going to be a place for rent-seeking activity that puts money in exactly the wrong places. So I'm a lot less skeptical of federal government's ability to deal with the infrastructure issues. I mean, we already saw in the $1.9 trillion bill that people had to raise a ruckus just to keep it from including that bridge from New York State to Canada that they wanted to put in it. Does that help at all?
Well, I appreciate your ideas about it. I spent a lot of time in China until this year, and everything in China is new, and everything here is old. And so there's a differential, and they do have trains that work, and they do have things that work, and there are apartments that aren't occupied, as you said, but a lot of them are, because they've moved a huge amount of the population into cities, and I don't want to do that. But it does seem like we do have some unaddressed problems. And
I agree with that. Yeah.
My own view is the great opportunity is in different energy sources, and so it seems like we could do things there that could build something, rather than just shuffle paper.
But I'll give you an example. So I was on the board for a long time of the company that manages the New England power market and the New England grid. And we had something called a market monitor who, wrote a report every year to make sure the market was operating correctly. And the New England states were trying to get more renewable energy into the market. They did, economists have always said, we'll have a carbon tax. That's the way to do it. But nobody wanted a carbon tax because that made transparent what the cost would be to consumers. So the market monitor at one point in his report listed what is the most effective way to reduce carbon emissions, per dollar, dollar spent per carbon reduction. It listed a bunch of things. The absolute most expensive was offshore wind. Down at the bottom was keeping the nuclear plants running, okay, and a lot of things in between. Well, what was the number one choice of New England politicians to reduce carbon emissions? Offshore wind, the most expensive solution. And so again, my problem is I think politicians, the offshore wind sounds fine, it sounds great, but there are a lot of much more prosaic things you can do that politicians, it's not in their interest to do because they're not flashy. Just like I think, most economists would say, if you want to improve mass transit, what you need is a denser bus network. You don't need to build, high-speed rail all over the place because that's very expensive and relatively rigid. But invest in more buses and get people to work better that way. If you were in Hong Kong, that's a beautiful transportation system that has all sorts of various levels of public transportation. But investing in the bus system, nobody wants to do that. I can't cut the ribbon. I can't spend $1 billion. And there's some poor people who ride the buses anyway. Why should I do anything like that? So again, a very cynical view of politicians and infrastructure.
Well, I preferred the Star Ferry. And I'm certainly not opposed to building nuclear power plants. That's another infrastructure project. So. Anyway,
Wait, I didn't say build. I said keep the ones we have alive because they're closing down all over the place.
Okay, I see Al has his hand up.
Well, just a quick comment on this infrastructure stuff. I think we have to have a broad definition of infrastructure, right? I mean, it's not just filling in the potholes. One of our highest investments that we would get the highest return from as a society, it requires us just to have a little bit of a longer time frame than thinking about the next year or the next 5 years. And that's investment in the social, emotional, and cognitive development of children. If we put money into that so that we have a rich environment for all the children in society, their productivity and quality of life is so much higher. And we know that that is orders of magnitude huge. And it's another example that's really part of the infrastructure because it's preschool and it's schools and it's teachers and it's a whole system. And a lot of this stuff, the market cannot address this alone. The market won't take care of 3-year-old kids all throughout the society. The market will not ensure that everybody has access to a 3rd grade teacher that's engaged, is high quality, that has few enough students that they can actually attend to them. So there are a lot of these things that we just have to think about, and there's no alternative but to have us as a society through our democratic government say, we're going to invest in this because this is what we got to do to have a reasonable society that is functioning in 20 years from now or something like that. So I think that's all part of the infrastructure thing. So I just wanted to make
no, I absolutely agree. And I think you should run for Congress because, what I'm thinking here is, so that kind of infrastructure, stop talking about creating jobs and moving the economy out of the recession through infrastructure. As you said, let's think about what makes sense for long run investment. And I absolutely agree. Every economist would agree that's the high return place. Let's also, the problem, of course, it's pretty prosaic. Again, I can't cut the ribbon. I can't spend, $5 billion at a whack doing that sort of stuff. So, think about, we took the money, that high-speed rail system they're building, we gave all that federal money for to build in California that's never going to go anywhere. That's a nice big project that politicians like. It's going to be totally worthless. And if we had taken that money and done what you've done, it would have had a much higher return. So my point is we need more rational, mundane thinking about it and less sort of big project. Oh yeah, let's
create a system so that it's ongoing.
Yeah.
Like we created Social Security once back in the 1930s, and we basically eliminated poverty, which was highly prevalent among senior citizens in the country. And the system has been going on, and we got to tweak it once in a while to keep it going on. We have to do the same in education and the same for transportation and these other infrastructure things. But I think we're out of time. I just wanted to make that comment.
Okay.
Thanks.
Oh, wait a minute. Al's on.
Al is definitely here, and I.
Hey,
So
Ray,
Al, I've been
can
just.
you hear me, Ray?
Yes, I can. I've been just making the business school go downhill ever since you left.
Well, yeah, it's been 10 years since I taught my last executive MBA class. 10 years this month, in fact. but it's great to see you after all these years. And I want to thank you for taking the time to do this presentation today. I thought it was excellent. And my only regret is that I didn't spend more time visiting your classes when I was at Emory and learning more about the Open Market Committee and the Fed instead of focusing entirely on the FASB and the SEC. But I did want to ask you to address one issue. You talked about the the deficit in relation to GDP. Didn't say much about the growing debt, and as a retiree on fixed income, I'm concerned about the possibility that our 403Bs could be and IRAs could be taxed in the future, as especially if interest rates go up and the federal government has to pay an even larger percentage of its total budget on paying the interest on bonds. So at what point are we going to hit sort of a threshold where we're going to see really major problems from this growing debt, total debt, which right now we're looking at what, 28, 29 trillion by the end of the year?
Yeah. So, but remember, 8 trillion is debt we owe to the Social Security system. So it's the public debt we worry about, because that's the debt where, people have a choice of putting it somewhere else. So you asked my students ask me this question all the time. And, here's right now, we're in a situation where there really is very little alternative. We could say, suppose the people who own what we call the debt owed to the public take 5 trillion of it and they say, I want to put it somewhere else. There's really no other place to put it because there's no market with the kind of liquidity that you see in the bond market. So
Right.
What would happen, I would expect, is let's suppose we think that there's going to be high inflation going forward and everybody else in the world does too. Then we would probably see this gradual buildup of alternative financial institutions. So people would take it and put it in the euro. I think it's many years before anybody's going to buy renminbi assets to take that place. But that would happen slowly over time. The problem is that, if we'll know the day after the debt becomes too much, because once people, begin to think that somehow we're going to struggle to repay it, or we're going to have to inflate our way out of it, then it's very likely we'll be very quickly into some financial crisis. But it's impossible for anybody to pick. People say everything's all right until it isn't. It's impossible to say exactly where that is. So, for instance, Japan has a debt that is 250% of GDP. Okay, but a lot of it's held by Japanese financial institutions, so people don't worry, and the yen is not an international currency. So people don't worry about somehow people losing confidence in the yen and in the ability of the Japanese government to pay. So we could, what I see happening is more likely what you said, is that the bigger the share of interest. So if you look at the Congressional Budget Office and you see their forecast of how much of the budget is going to have to be taken up just paying interest on the debt, and especially if interest rates rise, then that's going to go very large. Then what's going to happen is you're going to put pressure on the social spending that people will be doing. And that's going to be a big tension between intergenerational tension. And I think it's quite likely that somebody's going to come after your everything you own to pay for that. And I expect that's how it'll play out in the future. The only thing we've got going for us is that any politician who wants to, touch anything to do with Social Security or 401ks immediately gets unelected by the AARP. So, but that's going to change too, because, the dominance of this age group is going to gradually diminish over the next few years as well. I see a real tussle of generations coming in the future.
Well, thank you. I did want to assure you, you mentioned that you might be retiring in a couple of years. There is life after retirement. And I remember that round of golf we had together over at Piedmont Club several years ago. And right now I'm looking out over the 13th fairway and I'm holding my putter in my hand. So, thanks again, Ray.
Okay. All right. Sorry, I didn't give you a better answer on the debt.
No, I thought that was great.